Thank you for giving me some time tonight to visit with you all, and thank you for choosing Dixon Company to provide your audit services. I'd like to take some time tonight to cover the audit and the reports on those audits, look at some financial information that may be of some interest to you. As you're aware, the state auditor requires that Colorado local governments are audited, so you've met that requirement by being audited, and you are a reporter to not only the Colorado State Auditor's Office, but to the Colorado Department of Education. I'd like to invite any of you board members, if there's some things that we don't have the time to cover tonight, or the information, or we need to get into something else, to feel free to contact me. I'd be happy to visit with any of you. And if I get going too long tonight, somebody give me one of these or something, and I'll move along, and we'll do it at a different time. I really want to thank your staff, your consultants, for the effort that they made while we were here during the course of the audit. What they do, it makes it a lot easier. I could take it personally. I think they're starting to figure out that the harder they work before I get here, and the more they do, the less they have to deal with me while I'm around. So, but whatever the reason, I'm all for it. I appreciate the effort that they made. You are required to have an opinion on your financial statements. That's what the state auditor requires you to have, and that's what we'll talk about tonight. But in addition, if you spend more than $500,000 of federal financial assistance, you have to have an audit in accordance with not only accepted auditing standards, but generally accepted government auditing standards. And that requires that you also have a report on your controls over financial reporting and your compliance with the laws and regulations that oversee that. You also have to have a report on your controls over adhering to federal program requirements, and an opinion on whether or not you have complied with the requirements that might have a material effect on some of those major programs, a direct and material effect. So we'll talk about those opinions. We'll talk about some financial information. We'll cover some of the funds. The major funds, as you know, the major operating fund you have is the general fund. You have a grants fund, you have a food service fund, you have some co-curricular activities, and then you have a bond redemption fund to pay bonded debt, for which there is a levy. So we'll cover that, ask questions if you have them. Again, if there's something that you want to cover that we might better do in a different form, we'd be happy to do that too, but thanks again for the chance to do this. The opinion on the financial statements is on pages 1 and 2 if you have your audit report with you by any chance. I would want to recommend to you also, right after page 1 and 2, this opinion on the financial statements, there's a section called Management's Discussion and Analysis, and your financial management is required to provide some condensed financial information and some data and some information with regarding your operations, backward and forward looking. It's required by the standard on finance reporting for governance. And they have done that, and when that is done well, it's just as informative as anything you might find in the notes or the financial statements themselves. So we appreciate the effort they make to do that. We don't give an opinion on that information. It's the items that are in Roman numerals in your table of contents, about 8 or 9 pages. But we do have to read it and make sure that the information conforms with the financial statements, because it is included in a report on which we're giving opinion, and we have done that. Back to the opinion on the financial statements on page 1 and 2. It in essence says that these financial statements here for the year ended June 30th, 2012 present fairly, so this is a clean or unqualified opinion, present fairly your financial position at that date and the results of your operations for the period then ended. So the opinion on your financial statements is a clean opinion. The report on the controls, that generally accepted government auditing standards I told you that you have to be audited under because you spend more than $500,000 in federal financial assistance, is actually on page 48 and 49. It comes in advance of the schedule of federal award expenditures. And what it says is that you have adequate internal controls over financial reporting to meet the requirements, that you have no significant deficiencies or material weaknesses in that area, and that you had complied in all material respects with the items that the laws and regulations, contracts, etc., that have an impact on, that would have an impact on your financial statements. The final report that's to be given, again, because you spend more than $500,000 in federal awards, is a report on your controls over the oversight of federal programs, and then whether or not you've complied with the requirements of those federal programs. And that opinion, a report, is on page 50 and 51. And it also says that we've taken a look at your major programs as defined in the schedule, and the ones that were chosen were looked at, and that there were no compliance you are not out of compliance with anything that would have a direct or material effect on any of those major programs that you administer here, and that you have adequate internal controls in place to oversee the administration of federal financial assistance as required by the Office of Management and Budget. So those are the reports and opinions that you're required to have given on your financial statements and your scheduled federal awards. Let's take a look at some of those financial statements briefly. And again, this is at a fairly high level. If you have questions, ask. Hopefully I can answer them as we go along, even before you ask them. Let's take a look at your major and most important operating fund. That's your general fund. And if you look at page 34, there is a schedule that's required. It's required supplementary information. And what it does is it sets out your revenue sources against what you budgeted originally and what you finally had approved, and then what your expenditures were against what you originally budgeted and what you finally approved. You can see there that in page 34, about the middle of the page, you budgeted for about $10.1 million in revenues, and you had about $10 million, or you were about $177,000 under your budget in your revenue receipts. Lined up in functional areas of instruction, student support, going on the next page, instructional staff, general administration, which is the Office of the Superintendent, school administration, which is the Office of the Principals, business services, maintenance, transportation, those areas. You can see there what you had budgeted, what you expended for the period in those areas. Getting over to the final page, which is page 37. Page 37 shows that you had $10 million, and that $10 million in revenues was offset by total expenditures there, that second line in the actual amounts column, of $10.7 million. So that before making any transfers to the food service fund or to the activities co-curricular fund, you had a loss or a net expenditure in your general fund of $721,730 for the year ended June 30, 2012. You made required transfers to operate your food service fund and your co-curricular programs of $350,000, so that you actually had a net expenditure in your general fund of $1 million. That took that $2.6 million fund balance down to $1.6 million as of the end of 2012. I might indicate, just so that you have some perspective, the previous year, the fund balance started at $3.87 million. So in 2 years, you've gone from $3.87 million in your general fund balance to $1.639 million, or you've expended about $2,237,000 more than you have taken in over that time frame. And your fund balance is now reduced at June 30, 2012 to $1.6 million. That's in the general fund. More significant might be the fact that, well, first of all, if you had another $1 million loss, if you continued to lose money at the same pace you had the last couple of years, you would have somewhere around $650,000, $600,000 in fund balance at the end of this 2013 period. But maybe more importantly than that is what makes up that fund balance. And if you want to go back to the balance sheet on page 5, I'll talk to you a little bit about that. The balance sheet on page 5 indicates that in the general fund, you have some cash, receivables, things like that, but you have to pay accrued salaries, other things, other liabilities. So you can see there in the next to line, next to last number is that fund balance we just talked about, right? $1.6 million, 1.639592. But $309,000 of that under the Colorado Constitution has to be reserved for emergencies. $414,000 of that under the Colorado Constitution has to be reserved for multi-year obligations. $30,000 of that's in the scholarship fund. So when you get down to it, your unassigned fund balance at the end of June 30th, 2012 was $885,000. So you can see that if you had a year similar to what you've had in the last two, you would use up 100% of your unassigned fund balance and be into those required funded areas that are required by the Colorado Constitution. That fund balance of $3.8 million was somewhere 2 years ago was somewhere around the tune of 40% of your annual operating expenditures in the general fund. You now have about less than 10% in your unassigned fund balance, or 0.8 of 10%, so about 8%. So that's the financial position and the results of operation in the general fund for the year ended June 30, 2012. Let's take a quick look at your grant fund, and I'll say quick because Grants operate on a we get it, we spend it basis, you know, that they even out. So on page 38, you'll see that in your federal and state grant programs, your designated grant fund, you got about $726,000 of revenues equals $726,000 expenditures, and that's an accounting convention that if you've made eligible expenditures, you get to set up a receivable for those revenues and recognize them, and that's why it is exactly the same. So your expenditures are within those programs. You budget for those based on the fact that you know you're going to get No Child Left Behind grants, etc. You know what they are. You budget for those. You expend what you get, and there's no subsidy from the general operating expenditures of the district. That's designated grants. Let's take a look at food service. That's on page 40. Or loss before transfers. That's the fourth line up from the bottom or so. Your net income, your net loss in your food service fund for the year 2012 was about $178,000. So you were required to transfer over $175,000 to subsidize that program. So that money comes out of your general fund, of course, so that you had a net income or loss of around $3,000, taking your beginning net assets from $85,000 to about $82,000 at the end. So that 175 is the same amount that was also, by the way, transferred to co-curricular activities, and we'll take a look at that here in just one second. Let's do it just this second. So if we looked at co-curricular activities, let me give you a page number on that. That would be page 43. Co-curricular is your student activities, your athletics, your Knowledge Bowl group, the groups that travel in co-curricular academic and co-curricular athletic areas. So there was local revenues or fundraising amounts, things like that. Gate at ball games, things like that, about $37,000. There's the co-curricular expenditures of $274,000, and you transferred $175,000 over there to support that. One of the things the district did after we had an exit conference last year is we talked about the fact that there had accumulated some monies in those co-curricular funds, and there's no reason to there were no reason to accumulate those monies there when they could be left and used in the general fund. So the transfer annually had been somewhere around the $240,000, $250,000 range. The district reduced it to $175,000 in this year, ended 2012, because there was money available over there already, taking that fund balance down from $108,000 down to about $46,000. So of course that can't be done again. That was a one-time savings to the general fund to reduce that transfer by a fairly significant amount and use up that fund balance that had accumulated within the co-curricular funds. And finally, you have a bond redemption fund, and it's also pretty much a break-even basis fund. You levy amounts to pay your debt service. So on page 42, there's a budget to actual statement for that. It shows the property taxes that were levied and collected of about $540,000. Your debt service principal interest of a similar amount, so that your fund balance in there is the amounts that have accumulated to pay debt in the 6-month period upcoming. At the end of the debt service, if there's any residual, which there, given normal budgetary conditions, there won't be, you'll get down toward the end, you'll only levy enough to pay your debt in the final period, less whatever fund balance you have left, and that will close out the fund. If that weren't to happen, you would have to transfer those monies, or a residual equity transfer back to the general fund.
And what is the amount of the mill levy that generates $540?
I don't know.
No.
Yeah, I did know when I was doing the audit, but I can't tell you, Larry. But you have just certified probably, or about to certify this month's levy. That's the for the debt? Okay. So you levy to raise about $1.5 million in your general fund. You levy to raise about $500,000 in the debt service fund. So even I can do the math that it's about a third in the bond fund as it is in the general fund. One other thing I wanted to point out, I talked to you tonight about your funds, because that's the way you think, that's the way the budget, that's the way you get your monies, that's the way you expend your monies, that's the line items you're aware of. But these financial statements also require financial reporting. It's what's called an entity-wide level. You take those funds, you put them together, and then you bring in other things. You bring in your fixed assets, your property in this district. You bring in the debt. So I want to point out some of those things that combine up to the entity-wide financial statements. If you look at page 26, in the footnotes, it gives you an overview of what this district owns in capitalized depreciable assets within your governmental funds and within your food service fund. So you can see there over time you've accumulated by acquiring, building buildings, those kind of things. You've got land of $667,000. You can see your building amounts there, $18 million, adding up to depreciable assets of $21 million. They have been depreciated over the years to the tune of about $14 million. So your net, the net value in your property at a fair value for depreciation is about $8 million at June 30th of 2012. And you can see there in the food service fund you have about $362,000, which has been depreciated down. That helps you to understand maybe the age and sometimes the condition of your equipment. That's why it's required in these entity-wide statements. If you look and see, well, we've got equipment of $362,000, but it's now nearly fully depreciated, that gives you some concept of how long you've had that equipment and what condition it might be in, just like it would with your buildings or your other equipment or your buses or anything like that. The other thing that gets brought in beside those significant assets is your debt. You just think about debt as we've got to pay it in the fund level. Levy money, we'll pay the debt. But what is that debt? It's also in the notes of the financial statements. If you look at page 32, there's a schedule there that shows you have some long-term debt. You have general obligation refunding bonds that you issued to refund debt that you used to build some of the buildings in the district. That's the one that makes that $500,000 that you levy for every year to make your bond payments. And you paid it down $400,000 from $4.5 million at the start of the year to $4.1 million at the end. You have a program in place where you pay some of your employees early retirement incentives. So that debt has to be recognized and recorded. So the short-term portion of that is about, in the first 60 days or so after the end of the year, $6,000 was paid. But there's $80,000 or so that's in your long-term debt that you owe to employees that have been paid, and you've promised them that you'd pay them an amount over time. So those are the two areas that you actually have debt as defined for financial statements. You also have another type of debt, and you can take a look at it on, going to be the final number we'll talk about, and then I'll tell you the questions if you have them. Let me see if I can find a page I'm going to give you. As you're aware, you have a liability that has to be recorded in your financial statements for what we call compensated absences. If your employees have accumulated leave for sick leave, vacation, that kind of thing, it has to be indicated. So page 21 shows that at the beginning of the year, you had a debt for accumulated compensated absences, an estimate of what you owed your employees at this point in time based on leave accumulated of $1.249 million. At the end of the year, it's $668,000. You say, well, did we pay off $600,000 of that? You didn't. You might recall that just previous to this year, there had been a significant change in the policies with regard to how this was calculated. Previous to this year, it was being calculated on, it only took you 10 years to vest and be awarded your days. You were paid on 75% of your per diem, some circumstances like that. You made a policy decision to go back to 15, which is what it was previously, years to vest, and pay 50% per diem as opposed to 75% per diem. That, plus the fact that you had several retirees last year that you actually did pay off their accumulated compensated absences, is what created that reduction of a liability of $1.2 million to start the year down to about $668,000 at the end of the period June 30, 2012. Just so you can see some of those things in a financial statement, and it'll be the last one we'll point to. Look at page 3 with me, please. This is where all of that is pulled together. All those funds that we talked about, then these assets that we talked about, the depreciable assets, and then the debt. And now you can see it all together there on page 3 in your governmental activities. There's all the cash of all your funds. There's all those capital assets, $22 million, $14 million in depreciation. So that you have actually total assets in this district of about $12 million. But then there's those liabilities. You have to pay accrued salaries and benefits of $1 million. Accrued salaries is nothing more than the fact that your employees, your certified employees, have satisfied the requirements of their contracts by the end of June. They've taught every day they're going to teach, but you're still going to pay them in July and August because you pay them over 12 months instead of the months that they teach. So you owe them that money, that part of their contract. So that's just a calculation of what you owe to your employees for July and August salaries and benefits. But then down there you can see that comp absences we talked about, the retirement incentives that are payable, the bonds payable, and that's how you get to now, what are our real net assets of this district? Well, we have 12 million in assets, we have 5.9 million in liabilities, that leaves about 5.9 million in net assets. But you can see of that, 4 million is your capital items less debt. That's not money, that's not something that you can spend, that's not something you can convert into a liquid item so that you could support your current operations. That's capital assets, net debt. Again, there's those reservations. You have some money set aside for debt service. We just saw that in the bond redemption fund. So that your unrestricted net assets as of June 30th, 2012 are $385,000. Is there anything else that, I hope I didn't take too much of your time. Again, I invite you to visit with me if you would like to cover some more of this. Appreciate the time to spend with you. I thank you for that. And I'll answer any questions that I can tonight or promise to try later if you
But
need
there
to
were
do that.
no items that you determined that there was a question of materiality, is the way I interpret your...
Yeah, I would say that our opinion on the financial statements is that they fairly present results of operation and financial position. So there's no material misstatements in these financial statements. Additionally, there were no compliance, out of compliance items that would have had a direct or material effect on any of the federal programs. Yes, sir.
Appreciate it.
Thanks again. Appreciate it.
Thank you, Mike. Appreciate it.
Okay, moving on, we're at 8.4, our transportation update.